Welcome to What's in Your Pocket, a heartfelt conversation about money. Today I'm going to cover what I would do going back if I had my first $1,000 to invest. It's your host, Marcus, and stay tuned for this one because it's a good one. Now, when we're starting to invest, right, we really need to understand why we're investing and what we're investing in. So the first rule is to not invest in anything that you don't understand. And unfortunately, we're not all born all-knowing. So we have to start educating ourselves. In particular, what you want to invest in. What type of returns are you looking for, and what type of investments are you looking for? Are you a real estate person? Very high stress. You're leveraging other people's money, which does come with considerable risk. Are you a consistent, low-cost investor that just wants good, consistent, predictable returns? Or are you someone who's comfortable with volatility and the potential loss of all that you invest? Especially if you're younger, you can have a higher tolerance risk because generally you're dealing with lower amounts of money and you have time to recover from more significant losses due to the fact that you're younger. However, being smart in investing and recognizing that you should be investing for the long term will greatly benefit you in the long run. So I recommend, when you're younger and you're just starting getting into it, educate yourself all of the time. Take the time to learn, whether it's YouTube, podcasts, reading. Take your time and understand what you're investing in and why you're investing in that particular asset. And what I mean by educate yourself is when someone asks you, why do you invest in mutual funds? You should be able to list the reasons why you chose mutual funds over, let's say, individual stocks, day trading, ETFs, commodities, all of these different type of investments. You should have an explanation as to why you chose the particular asset that you did over another one. Now, of course, there's benefits and disadvantages to certain types of investments, but I'm just going to cover what I would do with my first $1,000 if I was getting into investing. Now, my launch point is I want good returns, consistent returns, and somewhat mild risk. Now, when I say somewhat, I mean I'm willing to take on certain risks, but I don't want to put all of my money into one, let's say, cryptocurrency that has very high volatility because I want good, consistent, predictable returns. So I'm more of a patient investor. I'm long-term thinking. I don't need to become rich now. I just want good returns consistently over a long period of time, and I know that that will result in a good amount of money accumulated in retirement. So that's where I'm launching with. That's my perspective on investing. Yours may be different, but I highly recommend that you just listen to what I'm saying here because I make more money investing now than I do working, and that's pretty impressive, I think, for a 20-year-old. Now, I'm not a day trader. I haven't made all of my money in one type of asset, one cryptocurrency, or anything like that. I've just managed to get good, consistent returns over the last 4 years that have accumulated in more than my earnings per year. So I really want you to think about that because it's important to understand why you're investing, right? And so if you're a day trader and someone who really enjoys the stock market and you're in your tenacity about it and you have this urge to really understand every aspect of it, then day trading might be for you. But for the average person who doesn't have the time nor the desire to look at charts for their entire life and earnings reports and all of those things, that's not a good generalized plan for the average person. So my plan is going to be more tailored to the average person who wants to invest, set it, and leave it type of investment rather than hands-on all of the time. So for me, with long-term investing in mind, I have two investments that I generally lean towards when I'm just getting started, and especially now, they've performed well for me, so I'm comfortable with them, and I know more about them than I do others, and that's ETFs and mutual funds. Now, they're very similar in a lot of aspects, but they're different in other ones. But I'm not going to explain what a mutual fund is or what an ETF is in this episode, but I rather want you guys to take ownership of your investing journey and go do your research on this. That the two main differences is our ETFs are traded throughout the day, whereas mutual funds are traded at the end of the day. Meaning whatever the price goes up and down throughout the day, and ETFs adjust in value according to the market, whereas mutual funds only trade at the end of the day. Meaning whatever the closing price is, that's the gain or loss of that day. So you really don't have any control over, selling a mutual fund when it's high and buying one when it's low. you don't have such great customization of a mutual fund, whereas you do with an ETF. So I prefer ETFs if I'm going to be more of an active role in it, meaning I'm going to check it, daily, weekly, or whatever, and kind of get a good feel for the market, whereas mutual funds are the more set it, leave it type of investment. But I do want to cover the expense ratios because I think this is one of the most overlooked aspects of mutual funds, is they are generally significantly higher than ETFs. And why is the expense ratio so important? Well, I challenge you to pull out a calculator right now, and I want you to do a calculation for me. I want you to do $10,000 at 10% return over 45 years. And I want you to write down that number that you end up with. And then I want you to do the same calculation, $10,000, 10% return, 45 years, but only at 8% return. Okay? I want you to do that same calculation, but with 8% instead of 10% return. And I want you to see the dramatic differences that just 2% over 45 years accumulates to. It's unbelievable. You would think it's not very much, but I promise you, you will be very surprised when you do this math. Now, this is important to understand because with mutual funds, your expense ratio generally is, between 0.25 and 1.25%. Some are significantly higher, some are lower. Whereas ETFs, they can go as low as 0.02%. So it's a very dramatic difference. And I haven't seen tremendous returns in mutual funds to compensate for that significant higher expense ratio. So I lean towards more towards ETFs for that specific reason, is the expense ratios are significantly lower, meaning I don't have to earn as much of a percent return to have the same earnings at the end of the day, right? So I can get a lower annual rate of return, but still have higher annual income for me and accumulated growth due to the significantly less expense ratios of ETFs. Now, that's not true with all of them. So do your research on this. A lot of Vanguard ETFs are really good in this. They're 0.03% versus a mutual fund that's, 1%. So do your research on this, but I beg you guys, go do the math. It's unbelievable how much 1% over 45 years makes. So it's important to understand the expense ratio between your types of investments. Now, of course, there's obviously variant degrees of how far they are different, but in general, ETFs are significantly lower in the expense ratio. Now, another part that I want to talk about is when we are talking about ETFs or mutual funds, they're very similar in the way that they operate, except for the trading times, right? But I want to talk about something called active mutual funds versus index mutual funds. Now, actively managed mutual funds try to outperform the market by making riskier investments in startup companies, and they're trying to outperform the market consistently. However, statistically, this is not the case, and generally they end up falling short of the market due to the increase in risk in those types of actively managed mutual funds. If you are choosing to go with mutual funds, a more laid hands back way, I recommend wholeheartedly, and every financial person would agree with me on this, is statistically index funds that follow the market perform better than actively managed mutual funds. If you choose mutual funds, look for a low-cost index fund that follows the S&P 500. These are going to give you the highest rate of returns over a long period of time. They generally average between 8% on the low end and about 12% on the high end. So do your research, guys. Make sure you look up your mutual funds before you invest in them. Make sure they have a low cost, and they're an index fund that allow you to have higher rates of returns consistently over a long period of time without significantly high expense ratios. So for me, if I was to go back for my first $1,000 and I'm looking to invest, I would invest 75% of it in Vanguard ETFs. Now, you can look up the symbols for these: VOO, VOOG, VUG, and you can look up those. Those are ones that I highly recommend. They have lower expense ratios, and they have good performance over the last 20 years. Now, of course, there are hundreds and hundreds and hundreds of other good performing ETFs, but those are some of my favorites. As far as mutual funds, I'm not going to talk about my particular investments in mutual funds because it's a little more complicated, and I have specific reasons why I invest in some and I don't invest in others. But do your research on this. Take your time, okay? It's not like you have to get in the market right now. Give yourself 6 months. Educate yourself. Read books. Read John C. Bogle's Common Sense Investing. Take your time. Learn the market. Learn the type of investments. Just give yourself patience, okay? It's better to take 6 months and invest wisely than to invest unwisely immediately, okay? Don't invest your $1,000 in Dogecoin and hope that it goes up, okay? Dogecoin is a speculation coin. So don't look at the market and what everyone is pushing and be like, I need to get on that right now, because it doesn't have statistical returns over a long period of time that will result in you having money in retirement, okay? Because you can make a lot of money really quickly with up-and-coming cryptocurrencies, but you can also lose a lot of money very quickly. So as far as long-term investing, they're not a wise asset to start purchasing in. So I recommend low-cost mutual index funds or ETFs. Do your research, take your time, look at them. I recommend a lot of Vanguard ETFs. If I was to go back, that's how I would do it. I would invest 50-50 between low-cost index funds and ETFs that follow the S&P 500.